Let's start with, and often when I meet with clients, we start with wealth transfer taxes. I think because it is probably the most complicated aspect of an estate planning. And so I think sometimes I tell them, if you'll hang with me on the estate tax and GST tax and gift tax, the rest of it is a little more tangible, a little more easy to wrap your arms around. So when I say wealth transfer taxes, most people have heard of estate tax, they've heard of gift tax. There's also another tax called the generation skipping transfer tax, or GST tax. And I find that most people don't talk about that or explain it, so I will talk about all three. And I think it's important to understand we have a tax on the transfer of wealth. It's not an inheritance tax. It is the tax on the transfer of wealth, be it during your lifetime or at death. So let's kind of talk about the history. It was implemented in the early 1900s. When I say it, estate and gift tax, not GST yet. And it was a way to redistribute wealth. We had the haves having lots and the nots having very little. And so agree politically or not, or philosophically, it was implemented to redistribute wealth and use some of those monies for programs to assist. The first gift and estate tax was a 90% tax. So when we look at some of the rates, it makes it seem better when you think at one point they were 90%. In my career, that's not that long, in 1998, the rate was 55%. So it is a huge tax when it applies, and so we're in a better position than we've ever been in the past. That's the good news, but it's not insignificant, and it's worth spending some time talking about. I think a lot of people think that estate tax has no impact on them. My estate's too small. There are ways that it does impact all of us in some form or fashion. So if you give leave a bequest, the estate tax is what most people are familiar with. Some people call it the death tax. It has different synonyms. The one place, I've left you two handouts, and I'm not going to go through them point by point, but give you more just some information to take with you, so hopefully you can just kind of think through and engage, and then you've got the figures later. But one place I want you to pull it out while we're talking is the wealth transfer taxation handout, the very last page. There's a chart. And so as we're talking about these wealth transfer taxes, I think you might find it interesting to see historically where some of the exemptions and deductions and tools have been and where we currently are. So what is the estate tax? It is a tax on the transfer of wealth at death. It doesn't matter if it's in a trust, it goes through a will, doesn't go through a will, has a beneficiary designation. Anything you own when you die is potentially subject to an estate tax to go to the intended beneficiaries or organizations. So the biggest tool that we have to use and have always used is an exemption, an amount that you can pass to whomever you choose free of estate tax. That exemption was $600,000 in 1998, and a lot of folks still even remember that number of $600,000 was kind of hardwired in there for a while. That was the amount that each of us as an individual could pass free of estate tax. And you start to think, gosh, a lot of people have $300,000, $400,000, $500,000, $600,000 houses. What if I have a $250,000 life insurance policy? We will talk about a number of myths. That's one of them. Life insurance is part of your taxable estate for estate tax purposes if you own it. And most people own their own life insurance. Life insurance agents will emphasize the income tax-free characteristics of life insurance. So the recipient does not pay income tax on life insurance. There's no income tax. But if you own it, that $250,000, $500,000, $1 million is part of your taxable estate. And so I actually talked to a woman who sells insurance about 3 months ago, and we were talking at lunch, and she said something, oh well, insurance isn't included in the taxable estate. And I thought my head was going to explode because this is a woman who sells life insurance. So I said, yes, it is. Well, no, So we had this discussion, and then bright lights went off, and I thought, this is a person selling this product who doesn't know it's part of your taxable estate. So it is. So as we tell people, if you sit down and you add up my retirement account, my house, my checking accounts, my cars, maybe I own a lake house, I've got the life insurance, and then you add it up, and often people truly are worth more dead than alive, right? And they add it up and they think, whoa, why do I don't feel that rich. But when you pass, all of that is part of your potentially taxable estate. So, good news, that exemption, if you follow the chart down, we are currently 5.43 million. So a little bit of change, you know, since 600,000. So it's actually written as 5 million indexed for inflation. So this year it's 5.43 million. It'll probably go up $80,000 to $90,000 next year. That's what we kind of anticipate. So that is great news. The rate of tax is still 40%. Only 0.5% of the population has estates over 5.43 million. So that is good news. We have a big hammer in our toolbox to use with this exemption, but it's still something that we need to not ignore. And there are people out there who have some exposure who may not realize they have exposure when you sit down and add everything up. Businesses, farms, those kinds of things often are illiquid, but they add up to a lot of value for purposes of estate tax. So we have the deduction, the exemption. It's sometimes, this is the other thing with estate planning I found, there's lots of synonyms. People will call one concept 8 different names. So this is an example of that. The estate tax exemption amount, applicable exemption amount, unified credit. There's all kinds of names for this, but it's the amount that you have for your lifetime for estate tax exemption or to cover estate taxes. Now, one of the synonyms I mentioned was unified credit. That comes from the fact that you have a credit from estate and gift tax, and you can use some of that $5.43 million exemption during lifetime for gifts if you want. So I'm going to just assume we may have one of you in here over 5.43 million. I'm not, and I don't think I ever will be. But all of us may be the recipient of a gift or the donor or giver of a gift. So gift tax, how does that work? We have an annual exclusion amount, an amount that you can give each year to as many people as you want to. They do not have to be related to you. I've had a lot of people say, oh, it has to be my children. No, you can give it to strangers, a friend, whoever you choose. $14,000 per year per person is our current annual exclusion amount. The amount people are familiar with is $10,000. So a lot of times people have heard 10,000, 10,000. It was that, and it's been indexed for inflation several times. So it was 11 for a while, 12, 13. We're currently at 14. So $14,000 per year per person that you could give a gift. The recipient pays no income tax on that. So estate and gift transfers are not subject to income tax. And you pay no gift tax, and you don't have to report it. You don't have to do anything if you give gifts of $14,000 or less per year. So does that make sense? Have you guys? I found a lot of people aren't aware that it's 14 now. They still think it's 10 or 11 or 12.
And it's
yes.
14 to one person.
Yes. Now you bring up a good point though. If you're married, say you've got kids, together you can give each kid $28,000. You can give their spouse $28,000. So if you're a married couple and you have a daughter and son-in-law, and you really want to move some wealth to them, you could do $56,000 per year per couple. So it is a powerful, easy. You don't have to pay a lawyer to do anything. You don't have to report a gift tax return. Just keep it under $14,000 per person per year. No consequence. Yes?
Is that taxable income to the recipient?
It is not. It is not taxable income to the recipient. And the same with gifts or bequests from a deceased person. No income to the recipient. A lot of people are like, wow, this is a great gift. Am I going to have to pay tax on this? No. When you receive a bequest, no income tax.
So
yeah.
we have like UTMAs for our children or college funds.
Uh-huh.
So if we gifted the UTMA, since we're still currently the, I guess,
Custodian.
people,
Uh-huh.
right? Does that count as a gift since it's in their name? Or?
Yes. Okay, she used UTMA. Uniform Transfer to Minors Act is what that stands for. And it's a way of owning a bank account where it's for a minor. It's for somebody under 18. And you have a custodian, usually a parent or grandparent, who's in charge of the account. So the first question is, when you make gifts to that account, is that a gift? And the answer is yes. You really don't own it anymore. Your child owns it, or whomever. Even if they're under 18. Now, the thing with these accounts is when they turn 18, it's their account. So keep that in mind. And I've had people, what if I don't tell them? And I'm like, I'm just telling you, it's their account, and if they're aware of it, they are the owner, they can do whatever they want, they can blow through it. So one thing that we tell people is you just want to keep in mind that those kinds of accounts, when they turn 18, you probably want to look at how much is in there. And we've really found that it's not necessarily the best long-term annual gifting sort of vehicle, because it'll build up maybe more value, and then boom, at 18 you lose control over how it's used. I mean, I'm sure I was really responsible at 18 and would not have blown through it. But you never know.
You didn't go buy a Humvee?
No. Yeah, don't. My parents, no, I did not have. Now, actually,
the gifting right is not a tax write-off for you.
No.
Just
But,
you're
okay,
doing it
but then the other part of her question, she talked about Section 529 college savings plans. The 529 comes from the Internal Revenue Code section that provides for that. What a 529 college savings plan is a way to put money in an account and let it grow income tax free, kind of like a retirement account almost, but it grows income tax free. And then when the beneficiary of that account, your daughter or granddaughter or whomever or friend, goes to college or voc-tech school or any of the authorized types of school, they draw that out, it's also income tax free. So it's kind of a beautiful thing. When you make a transfer to one of these accounts for the benefit of someone, it is a gift. But you assign a custodian or I think they call it a custodian, and then you can put a successor. So one of the things we do with our clients is, do you have 529 plans set up for your kids? Let's make sure if you pass away, there's someone named to manage that account for them and on their behalf. This is the one vehicle where you can make annual exclusion gifts in advance. The only way you can do this. You can do 5 years worth of annual exclusion gifts to a 529 account for the benefit of a grandchild, and then you can't make gifts the following 4 years, but you can front load it so it gets in there and gets growing and appreciating for their benefit. It is the one annual gift exclusion vehicle where you can do that. And so we do have some.
$70,000 gift that can just, and it counts as the $14,000 for, okay.
Yes.
Is there a time limit when a grandchild would have to use that? Can they use it when they're 50?
They can, and there's, let me back up a little bit. Each state has their own plan. You don't have to go to college in that state or live in that state. You can set it up. I know people in Oklahoma who use the main 529 plan. The benefit of Oklahoma, if you are an Oklahoma resident making contributions to Oklahoma's Section 529 plan, you can get a partial income tax deduction on your contributions. I'm not sure if there are any accountants in the room or anybody who knows what that is. It's definitely not $70,000. But you do get a Oklahoma state income tax deduction for at least a portion of that contribution. That would be the benefit of using Oklahoma's plan as an Oklahoma resident over using Maine's or Texas's or some other states. And you don't have as much discretion or control about the investments. It's generally set up so that if I start one for a 2-year-old, it will be much more risky than if I set it up for a 16-year-old. So as the child gets closer to actually using it, they can. So then you name a beneficiary, and what if that beneficiary decides they're not going to go to VOTAC or college or junior college? You can transfer and change the beneficiary to another family member, and it's pretty broad. So there's some flexibility that way. If they take it out and don't use it for educational expenses, they pay income tax on it. But if you go to, there is a website for Oklahoma's plan, and it actually is really good about a lot of the frequently asked questions. And it's ok4saving.org. I think it's org or com. But if you want to check that out, it's easy to do. I'm going to sound like I'm talking legal work. You don't have to hire a lawyer to create anything. You get online, you can establish the account, and they really are pretty easy to use and a pretty powerful way to gift. Because you're gifting to people who are younger, you don't want to give them control of that money. It's growing income tax free and will likely come out income tax free. But yeah, older adults, sometimes people pick, they're going to go back to school and they have a family member who wants to establish one for them. You can do that too. There's no age. Anything else on the 529s?
Is there if you put in the 70,000 in 16?
Yes.
Is there a time frame where they can use it? It has to remain a certain period of time?
No. It just has to, it comes out income tax free if it's used for the qualified educational expenses. Now, what if somebody passes away before the 5 years are up? There would be some throwback into their potential taxable estate.
The
But
beneficiary pass away.
the donor, no, the donor. So if you made the big gift and then 2 years later passed away, the 3 years worth of gifts would come in. But I mean, some of those are kind of hyper technicalities. See, this is weird. This is how this works sometimes. I had 529 college savings plans down as an afterthought. But yeah, they're a powerful tool. They're an easy way to do saving for college and make sense from an income tax standpoint, but it's also a good gifting wealth transfer thing. So, okay. Now I see you got me off. Okay. So we're still kind of, so it's with estate tax, let me jump back. So we've got our exemption. We've also got an unlimited marital deduction. So anything you leave to a spouse, and there are certain, you have to give them a certain level of control, right to income and some things, but certainly an outright gift to a spouse qualifies for an unlimited marital deduction. So if I have a $4 million estate, but I leave it all to my husband, there is a $4 million estate and a $4 million deduction. So unlimited marital deduction. The danger with counting on that too much is it's sort of a delay tactic. If you shift all of that over in certain ways to your spouse, then when the spouse passes, there's potentially tax at that point. Now, another good news thing, the current law, in addition to the really generous exemption that each of us has and the lower tax rate, we have something that we historically have not had in the tax code. We've had it since 2010, I think. It's called portability of unused exemption. And what that means is if I have a married couple who passes away, or one of them passes away, and they didn't necessarily do any planning, they just had everything in joint tenancy with right of survivorship, it went to the spouse, and they were maybe worried about potential estate tax down the road, they can file an estate tax return for the deceased spouse and elect to make portable the unused estate tax exemption of the first person to die, so that $5.43 million exemption is available upon the passing of the surviving spouse. So that's a really great, powerful tool, but I think a lot of people are not aware that you have to sort of claim it. You got to file an estate tax return to preserve that. So know that it's there, but also know some of these things you're going to need some help of an attorney or an accountant to make sure you don't miss some opportunities.
There's a time frame on that as well.
There is. You need to file an estate tax return within 9 months of death, and you can get an automatic 6-month extension. But when somebody passes, 9 months often goes by really quickly. So when somebody passes, you need to visit with a lawyer or an attorney pretty quickly, because there are some time frames in which to work. We had a client, we did not do their estate plan, and they came to us, the surviving spouse came to us about 3 years after her husband passed, and they didn't file an estate tax return. And we really wished they had in order to have the ability to use his unused exemption. And so there are times when there have been some opportunities to have sort of a safe harbor and claim some things, but there's definitely, it would have been a whole lot easier if we had visited with that lady about 6 months after, within 9 months after his passing. So, yes.
Do you know if the laws are pretty similar across state lines, or are they
Okay,
different?
everything I'm talking about right now is a federal wealth transfer tax. And I'm glad you said that. We had an Oklahoma estate tax until January 1, 2010. And it roughly mirrored certain provisions of the federal, and we had exemptions and so on and so forth, and it was a much lower percentage, but it was there, no more. So wealth transfer, that's the other piece of good news. Wealth transfer taxes in Oklahoma, for Oklahoma residents, you don't have any worry about Oklahoma tax. Most states, and I bet Debbie would know more than me, Texas's is gone, isn't it?
Texas is gone. Louisiana, I think it went away last year.
I think so. But I mean,
Arkansas,
there's,
I don't think Arkansas does anymore.
but there,
Kinda gone.
yeah, there used to be a credit on your federal return for any state estate tax you paid. The federal government eliminated that credit, and a lot of the state estate taxes were based on whatever the credit would allow. So some of them went away automatically. Oklahoma's was not one of them. I don't think Texas was one of them. They were? Oklahoma was not. We actually had to repeal the tax. And so some of these states where it was a separate regime from that credit are gradually doing away with it. So, yeah. So that simplifies the planning from our standpoint a little bit. Oklahoma's estate tax system was pretty messed up. The exemption only applied to lineal descendants. It was, yeah, so it's gone. It's gone. Good question. The other tool we have with estate tax is an unlimited charitable deduction, and that's where Debbie's going to be spending some time on. You would think, well, okay, you make a bequest to charity. It can be used in some really creative, powerful ways, and so she's going to talk to you about that. But anything that you leave, any assets you leave to a 501c3 charitable organization, there's an unlimited deduction. So we do have some people who say, wow, I think I would rather leave something to an organization I care about rather than 60% go to kids. Do I want to pay 40% on the dollar over my exemption amount to the charity of the government? Some people do. A lot of people don't. So that's a powerful tool. Yeah.
So it is as simple if you had $6.4 million, you gave $1 million to the church, you'd be home free without having to pay any estate tax.
That's true. That's true. And I'm going to save some of that for Debbie on using that charitable deduction. But yeah, and it's it's a really powerful tool in some surprising ways. But yeah, we have some people do that. They're like, I'm right on the edge. And you can do maybe a formula in your estate plan that would say anything over the current exemption amount on my passing goes to my church or goes to the Oklahoma Disciples Foundation or whatever. Yeah. So, okay. The other thing with estate tax before I finish my discussion on gift tax is how many of you know what basis is? A couple? Okay. Before I went to law school, I didn't know what it was. Basis is very simply, what did I pay for an asset? So if I purchase, I'm going to use stock. If I purchase a share of IBM stock for $10, that's my basis, sometimes called cost basis. And there can be deductions in it and changes in it, but roughly it's what you paid for something. Or I bought a piece of farmland for $100,000. That's my basis. And why that's important is if I then turn around and sell the stock for $20, I pay capital gain income tax on the difference between my basis and what I sold it for, $10. Okay? So there's income tax to be paid there. The same with a piece of real estate, some farmland. I'm purposely not using your personal residence because there's other rules for that. That's your basis. You sell it and you pay income tax on it. So if you leave something to someone when you die, that basis steps up to fair market value or what that property is worth on the date of death. So I'm going to leave my share of stock to my daughter Kate, and it's now worth $20, and it was my cost basis was 10. If she gets it upon my passing, the basis is stepped up to $20. She turns around and sells it. She pays no capital gain. So that is a huge benefit of receiving an asset when someone dies. We have a step up in basis. So if you hear stepped up basis, that's what that means. Does that make sense? Now, let's go back into our gifting structure. Okay, I want to make some gifts. And before in our examples of gifts, we were talking a lot about cash. You know, maybe we're making a contribution to a 529 college savings account. That's going to be cash. But what if I want to give the farm, and this actually happened with a client not too long ago. She said, I really want to give my farm to my son. I'm tired of dealing with it. I just want him to have it. He wants to pay the taxes and live on it and cultivate it. And so what we did was we said, well, what's the basis? Okay, well, say it's $200,000. What's it worth now? It's worth $1 million. Okay. Unlike at death, if you give a gift to someone, they don't get stepped up basis. They get what's called a carryover basis, and that means they get my basis. So this lady was trying to figure out, okay, if I give him the farm now, I'll use my $14,000 annual exclusion for part of it, and then I'm going to use some of my lifetime $5.43 million exemption, file a gift tax return. That's fine. And she wasn't going to be going over the $5.43 million when she passed. But we had to really say, okay, but he gets your basis. So he has a $200,000 basis in this farm, and if he decides to sell it, he pays capital gain on $800,000. So we talked through that. The other thing is, do you think the farm's going to appreciate in value? This was, you know, ladies in her 60s. Do you think it'll appreciate in value in the rest of your life or not? Well, I don't know. Maybe I want that appreciation to happen outside my estate. So we went through those things, and she ultimately decided she wanted to gift it to him because, frankly, it would have been in their family for years and years and years, and the son wasn't going to sell it. He really didn't think he was going to sell it, and her just not having to deal with it and pay the taxes and maintain it, and him just really owning it were more valuable than that issue. But it was something we needed to talk about. If she had decided to say, in my estate plan, I'm going to leave you the farm, it gets stepped up to fair market value basis when he receives it. So is that, I mean, sometimes I feel like that's sort of an advanced, sometimes people think that's an advanced topic, but I think people are always thinking about making the gift of the property before they die or giving them that stock from the company. And you just need to think really carefully about what you're giving, because that gift you're carrying over the basis of the donor. Yeah.
I sometimes have clients who are two generations buying property together, and so the older generation will actually pay for the property, and then we'll just put the younger generation in title with them. Does that count as a gift?
Yes. Yes.
So if you just add the name to the title, you have now gifted that property
Yes.
to them. Okay.
Yes. Because if they didn't contribute the money, then they have made a gift.
Would that count as like half of the property value?
Generally.
Joint title?
Mm-hmm. Now the other thing to think about with that is you have joint ownership of a piece of property, and that means that if any of those or either of those parties or any of those parties are sued, they own those assets, and they could come after them. So there are times when people say, and this ties into some of the other stuff about avoiding probate, but sometimes people want to add someone on the title to the house saying, well, we'll just be joint tenants with right of survivorship with John, and then when I die, John will just get the property, right? Okay, you avoided probate, yes. However, during your lifetime, their potential creditors, ex-wife, whatever, I mean, they own it. And you can argue and so forth that really it was just for convenience purposes, but why have that argument? The other thing is, what if you change your mind and you don't want John to get it? Guess what? John's going to have to sign the deed back to you. So I just think some of those issues are a little problematic and probably deserve some discussion from an asset protection standpoint, from what happens when somebody dies. Does that reflect your wishes? Yeah, and gifting. And sometimes, I mean, if somebody has a really small estate and they make a gift over the $14,000 per year and they don't file a gift tax return and then it's found later, I mean, what would happen is they would adjust their lifetime exemption from estate and gift tax. I mean, it's not, they don't owe money, there's no penalties, there's no interest. So that's probably less of a concern in a smaller estate situation. You've got to be a lot more careful about those things if people are going to be filing estate tax returns and then they're going to be under the radar and they're going to say, what happened to this? Where did it go and when did it go, and so forth. Also with gifting, let's see, there is an unlimited marital deduction. So you can give to your spouse back and forth all you want, doesn't matter. Charitable deduction for gift tax purposes is unlimited.
So what if you're gifting to a charity? And your basis was $10 on that stock, and
Yep.
now it's 80.
That is it.
To the charity is
Yes.
80, right?
Yeah. The value of your gift is 80, so you get your income tax deduction based on the fair market value of the gift. There's no gift tax because it's a charitable organization, and then the charity sells it,
Gets it
and
at 80.
they don't pay income tax on the sale because they don't pay income tax. So one year, when I had some stock from my folks that they gifted under the annual exclusion amount, and I wanted to satisfy my pledge at the church, I gifted some stock, and then I didn't pay the income tax on the sale, and neither did the church, and I satisfied my pledge, and so, yeah. And I'll save some of that. I'm trying not to get too much in the charitable stuff. So so the other topic under gifts that I want to emphasize, and this is something that I think 95% of clients and people I talk to are not aware of. Okay, in addition to the $14,000 per year per person, and again, doesn't have to be related to you, it can be anybody you want, you can make transfers for the medical expenses or educational expenses of anyone you want in unlimited amounts, so long as you pay the provider. So if you pay the University of Oklahoma, or you pay Dr. Smith or Mercy Health Center, you can pay those expenses for anyone you want and essentially transfer wealth for their benefit in an unlimited amount. The code section is 2503E. So if you want to ask your accountant about it. But a lot of people don't realize that, and what they end up doing is they'll give money to the daughter to turn around and pay the medical expenses. And sometimes that works fine if you're not making any other annual exclusion gifts, but I've just found a lot of people are not aware that you can do that. But the key is paying the provider of those services and not the person who's benefiting from them. Is that?
That doesn't count as a charitable gift.
No, that's a good point. It is not. That my daughter or whatever is not a 501c3 charitable organization. It's just, even though we think of our kids as charities, they're really not. But yeah, so just remember that, store that away if ever you need that. Or some of you are younger, you go, you know, Grandma, in addition to the $14,000 that you can give me for Christmas every year, you could also pay for my kids' tuition at Cassidy. Okay, so just something to keep in mind. All right.
So if it's medical expenses you're doing this for on this transfer, but that's not deductible or anything?
No, it's not a deduction for you, but it's a way of transferring assets and wealth without using your lifetime exemption, without using your annual exclusion. And so sometimes that's beneficial. There's no reporting, there's, not a lot of muss or fuss. And so every once in a while that comes in handy. Okay.
At our church in Wagner, we've been trying to figure out how to buy dentures for somebody, how to do some medical stuff for them. So you could do that with this.
You could get a bunch of, if several people who maybe were blessed financially wanted to contribute to that, they could all just write a check to the denture provider person.
Just do it that
Just
way.
pay it on their behalf and say this is for so-and-so's dentures.
But
You don't have
if
to.
you use it as an exclusion, you have to then do something different.
You don't need to use it as an exclusion because it's not considered a gift for gift tax purposes. It's just
It's just a gift.
It's not, yeah, but under the code, it's not considered a gift. It's just not. I can't remember what do they call it? I mean, in the definition of gifts, it's excluded. Yeah.
Can you have your cake and eat it too by giving it to the church, and then the church pays for the dentures?
No.
Because then you get kind of into the thing that Kyle talked about where, you know, the charitable organization has to be really careful about how they distribute monies. I think actually not funneling it through the church probably would be cleaner, don't you think?
For sure.
And just if some individuals who care about.
But this, my antenna went up when you started talking about
Yeah.
So what's the advantage to the donor on that?
it. No.
They don't get it. It's just they're in that particular case probably nothing because I bet they're not going to give a $14,000 gift to them. But if it's like, you know, if it's your child and you want, you know, a grown child, an adult child who has medical needs of $40,000 and you want to pay them directly to the provider, and then you also want to make a gift of $14,000 cash for, you know, whatever, you can. So it allows you to transfer more wealth to an individual than you could under the annual exclusion. And it actually comes up more often than people think because, you know, generally you're not making $14,000 gifts to 18 people. You might be making them to 2 people, and then you may want to help them in some other way, especially with education or medicine. You know, if somebody has a huge medical issue, even with insurance, I mean, they could have huge expenses, and if a older generation or a family friend wants to help them, I mean, and they could, I mean, and again, you don't report it on your gift tax return, you don't use any of your lifetime exemption. So it can be powerful, and I just find a lot of people don't know about it. I don't know that any of you, you know, necessarily will use it all the time.
Question, though.
Yeah.
If somebody is getting like disability and you gift that to them, is that income to them?
If not, if you pay the provider again, pay that provider directly.
Okay.
Yeah, that gets into a whole other. There are people who are being receiving government benefits because they're on disability, and you are right to kind of have your antennas go up on that because you can, especially in the estate planning and gifting, you know, from family members, you can really mess up their benefits if you're not careful. But in this case, I think this would be another great way to use that to help someone because you're not giving it to them. So I think that would work, but again, that's not really my area. The disability planning and special needs planning is not an area of expertise of mine, so I'm going to give that disclaimer. But I think it might be another way to benefit someone without messing up their situation. Okay, so now that everyone's, yes?
Back to the title question. So
Uh-huh.
like in that situation, would it be better to give the title upon death so that then you have the basis stepped up? And so like if I bought a property at $100,000 and then when I passed away, your net is actually now worth $150,000. Instead of adding my adult child to the title, if I put it in my estate that the property was passed to them, now they have the basis of 150, the fair market value, is that right?
That's true, yes.
So if they then sold it, they wouldn't have to pay the $50,000 inheritance tax, or is that, do I have that?
The
right?
what in?
I don't.
what inherit-
The capital gains, the $50,000.
Right. They wouldn't, if you receive something at death from someone, the basis is what it's worth on the date of death. And it steps up. We could like probably talk for an hour and a half about different ways that people want to get property to their children and maybe, you know, help them build their own estate. And sometimes you can sell it to them in exchange for a note and then just forgive so much of the note each year, and then they actually get the value. You know, there's all kinds of stuff you can do, but I just think it's really important to not use slapping someone's name on a title as a way to do, I guess, estate planning, gifting, because of the asset protection consequences, the income tax consequences, the gift tax consequences, and I think a lot of people don't realize that. Yeah. Let's talk about GST tax. Wow, before you guys eyes glaze over. All right, so I told you about our wealthy families in the early 1900s who were the reason for the implementation of gift and estate tax. Rockefellers, Vanderbilts, what have you. So they implemented this 90% estate and gift tax. And as you might imagine, these families had some smart lawyers and accountants out there to try to figure out ways to transfer their wealth down to the younger generations without getting that 90% bite. So one of the things they would do is create a trust for the benefit of the kids. Maybe they put, the company in it or a huge asset in it, and then the kids live off of the income and dividends and so forth during their lifetime, and the kids die. Well, they didn't own the trust, they were just a beneficiary of it. And so then the government didn't get their 90% bite when that generation passed, and it went on like that. So they were avoiding the estate tax at these generations. The other thing they would do sometimes is say, well, I'm going to give X amount to my kids, but then I'm going to give another amount to my grandkids, because if it doesn't pass through the estate of my kids and get taxed at 90%, that's powerful. Or maybe if I have great-grandchildren, I'm going to skip 2 generations and it skips 90% tax. So those two things were some powerful ways to transfer assets down without the impact of the estate and gift tax. So they implemented the generation skipping transfer tax as a way to close these loopholes, and it's equal to whatever the highest estate tax rate is. So currently the GST tax is 40%. But on your chart, if you look there, there's a GST exemption. And what that means is that each of us has a GST exemption of $5.43 million. It's currently the same as the estate tax exemption. For a lot of the time that Debbie and I have been practicing, they've been different amounts. But right now it is the same. And so what that means for us is that we can create a trust for the benefit of our kids when we pass, bless it with our GST exemption, then whatever they don't use or need or deplete during their lifetime goes to our grandkids and is not part of our children's taxable estates. So when I got out of law school and I was starting to do estate planning, and I looked at this GST exemption and learned that in school, and I looked at my parents' trust. And I said, hey, Dad, you don't have any GST planning in here. And his reaction was, what, you want me to skip you? And I was like, no, I don't want you to skip me. Please, don't skip me. But to the extent I don't need or use all the assets that you and Mom leave to me, let's not expose them to estate tax. So what I find in most of the trusts I see, is that from other attorneys, they've done their trust, including my parents. My parents had in their trust that if my sister and I were over 35 when the second of my parents passed, it just went outright to us. If you're not responsible by 35 and you blow through it, well, that's your problem. And so philosophically, I agree with that 100%. But the issue is now those assets would be part of my taxable estate. And if I win the lottery or something and I'm over $5.43 million when I pass, whatever my parents left me is going to get taxed at 40%. So right now, this is not as big of an issue, I don't think, as it was when we had $1 million exemption or a $600,000, $2 million exemption. However, we shouldn't ignore it. We don't know what the future holds for our children, and maybe they'll be wildly successful financially. We also don't know what the future holds for this estate tax system and the exemption. There are legislators who would like to reduce the exemption, for sure, and there are people who think that will happen. So my thought is, why not take advantage of all of these exemptions that we have available, utilize them, and then that way we're protecting it in the future. We're not skipping our kids. And if I blow through everything that my parents left me, no harm. Just because it says GST exempt trust on it doesn't mean I have to save it for my kids. But why not protect it if we can? Because if you have it in your estate plan that goes out right to the kids, you have eliminated the possibility of protecting it from estate tax in the future. So does that make sense? Kind of? Okay. Now, the other reason why, you know, a lot of my clients come in and don't have that real issue, or maybe, you know, their kids are teachers and ministers, and there's no way they're going to have a state tax exposure or what have you. Again, I'm not so sure that those exemptions aren't going to change. But the other reason why I really want to encourage you guys in your own plans, and when you talk to your attorney or look at your own trusts or wills if you have them, you don't want assets to go out right to the kids because of the GST exemption. But also, if you give them outright to your children, you've just exposed them to their potential creditors. What if you give them to them outright and then they put them in the joint bank account, and then somebody has a midlife crisis and they get divorced, and all of a sudden it's divided up in the property settlement and the divorce. So one of the things that we really have almost all of our clients do is leave the assets they're leaving to the kids in trust, make them their own trustee so they can manage it, invest it, blow through it, distribute it, whatever they want to do, but whatever's in there is protected from third parties. So you're not protecting the assets from the child necessarily, though sometimes we do. You can make somebody else the manager and the trustee of it. You can do a corporate trustee like JP Morgan Chase or Bank of Oklahoma, or Uncle Fred or whatever. But in most of the time, you know, most of my clients are like, at a certain age, it's theirs. And if they're going to waste it, they're going to waste it. But let's protect it from outside forces. So give it to them in this structure. And if you live an extravagant life and they get $300, we're not going to form a trust for $300, right? Or if they spend a lot of it and it diminishes and it's not worth maintaining as a trust, it could be terminated. You can distribute it all out, but leave it to them in that protected way. Does that make sense?
Mm-hmm. So if you had multiple children,
Mm-hmm.
Would you create a trust for each child?
Yes, I would. And there are a few circumstances where sometimes people will keep a trust together for a period of time before it's divided up, but I would say 99% of the time we separate them. Upon the passing of the second of a spouse or the person, we'd separate it into a trust for each child. So then if one child has greater needs, they're not sort of dipping into the share of the other. And as they manage their own, they can manage it and invest it in whatever way they want, and they don't have to be in business with their brothers and sisters.
So can you put portions of non-cash assets like property and whatnot
You can.
into so each portion?
You can. When someone passes and you're administering an estate, you can provide that specific assets go to specific trusts or people. You can also just say equally to each one, and then the trustee would allocate the assets. And in mine, the default is an undivided 1/3, if there's 3 kids, undivided 1/3 interest in everything. But if one of the children was more interested in the lake house than the other, you can do some switching, purchasing, allocating in different ways. These are like more sophisticated questions than I had anticipated. Good stuff. Okay, so I want to go through a couple other things, and then I'm just going to open it up for questions. Probate. Anybody ever been an executor or personal representative? We got one in a probate in Oklahoma? Yeah, because see, we got the responsible people in here, right? You're that kid who's so blessed to be able to administer everybody's stuff. And okay, probate is the process, the court process by which we transfer assets from a deceased person's name to beneficiaries. Okay, not everything is subject to probate. So, for example, you have an IRA or a 401k with a beneficiary designation, not a probate asset, goes straight to the beneficiary. We own that house in joint tenancy with right of survivorship, not a probate asset. You gotta do something, but not a probate asset. What else? Basically, that's it. If it has a beneficiary or it has a joint owner with right of survivorship, avoids probate. But let's say my house, I own it in a revocable trust, so it's not going to go through probate. But let's pretend that I just own it in my own name and I pass away and I don't have a will. What would happen is somebody would be appointed as personal representative of my estate, and it would be administered publicly in the county courthouse where I died and was a resident, or not where I died, but where I was a resident. The process takes, on the short end in Oklahoma, 4 months, very often 10 to 12, and I've seen them go on for years. And it is public record. So if you live not so much in Oklahoma County or Tulsa County, but I'm told in some smaller towns, people are really nosy and they got too much time on their hands, and they'll go over to the courthouse and they'll look at your will. They'll look at your inventory of assets. So the privacy thing is more or less important to some people. The time is certainly a hassle. The accounts that are in the deceased person's name cannot be accessed until a personal representative is appointed, and you got to pay a lawyer to do the probate process, and it's not really that pleasant. So did you enjoy it?
Not at all.
No.
It was because the trust was set up incorrectly.
Okay. So how? Yeah. Okay. They had a trust, but maybe assets weren't titled in the trust. They were still titled in the name of the person. So if you have a will, the will does not avoid probate, but it guides the probate court in how to distribute your assets, and they will honor that. If you don't have a will, there are state statutes that say if you're a single person with children, here's how it goes. If you're a married person and the kids are all of that marriage, here's how it gets divided. And it typically, especially once you get into the situation, well, anyone that's married, whether it's that, it doesn't go the way people generally want. It's certainly not going to go to any charitable organizations. That's not provided for in the statute. So if you have any charitable inclinations, not having a will or estate plan is not going to work. So in Oklahoma especially, it is a more tedious process. We have some folks that move from Texas. Texas has independent administration and is not nearly as tedious, I'm told, right? And so actually a lot of my colleagues down there, they will just plan on doing a probate. And they may set up what's called a revocable trust that we're going to talk about in a minute, but they plan on having a will that's called a pour-over will that just says, upon my death, anything in my name without a beneficiary pours over or transfers to the trust. And in Texas, a lot of times that's just what they plan on because probate procedures are not as complicated. They're not as tedious, and you can do a lot more independently and then just kind of report in at the end. So in Oklahoma, though, we want to avoid it. We really do. And so what we typically do to avoid that process is we will do a revocable trust. Sometimes, here's the one with the most synonyms of all. Revocable trust, living trust, loving trust. My least favorite. Because it's the loving thing to do for your family with a little copyright, you know. Anyway. Let's see. Can you think of any other synonyms? Management trust, that's nice. So what it is, well, my favorite synonym is really private will, because a revocable trust is a private will. It is an estate plan laid out so that your estate is administered privately. And for a lot of my clients, that works for them, because the idea of putting assets in a trust makes it feel like you're putting them away out of reach. Your revocable trust really is just an alternate ego for you, a different way to own it so that we avoid this court process and we can administer your assets immediately and privately. So in the trust you say, when I pass away, here's who's in charge. Here's where my personal property is going to go. I might leave you a note that says my ring goes to my grandchild. Do that stuff first and then everything else goes here, and then we're going to divide it into 3 trusts for the kids, and you know, so we have all that provided. You can amend it anytime you want. You can, you know, change it just like you'd change a will, as long as you have capacity and as long as you live. The tax ID number for a revocable trust is your Social Security number. So you don't file an additional income tax return. It doesn't change your day-to-day life in any meaningful way. So back to your point, what we see sometimes is people will have a revocable trust, and it does all the cool things they want it to do, and has even GST planning in it, and it protects the assets, and it says who the trustees will be. But they gave maybe the client, here, go put your assets in the trust, and here's how you do it, and they give them a memo. Go to the bank, go here, go there. Oh, we'll put the house in there. That's what I see a lot of times, is that there's not a follow-through on the part of the client or the attorney or the accountant or whoever to make sure that all the assets are moved into the name of the trust, or they have primary and contingent beneficiaries. So the person passes away and they're like, hey, you know, grandma had a revocable trust, this ought to be a piece of cake. And then they go into the lawyer and they have all these statements that say their individual name, right? Is that kind of what happened? So sometimes, well, yeah, so
On
that's,
on that one, the oil rights got in, but the property did not.
it's usually the other way around, yeah.
That's what happened on that one.
Okay. And if you have one asset that didn't get titled correctly into the trust or didn't have a beneficiary on it, you're doing a probate. So we do a pour over will for our clients, but I tell them 14 times, do not rely on this pour over will. This, if we use it, is going to require a probate. We want to get everything titled in the name of the trust, update the beneficiaries, have it all the way that we want, so that when you pass, no probate court, no legal fees, no delay. So, is that? So whether you're, depending on however your attorney, that's what we are. The attorney may or may not do that hands-on. I would say, you know, double check with them. It's probably worth the money to pay them to do that part of it, or at least guide you through that part of it, or double check it. And I don't know if the fees on estate planning, I'm really happy that many of my colleagues who do estate planning are doing fixed fee estate planning services rather than hourly. Eric is a reformed lawyer, and we love tracking our time in 6-minute increments. It's really awesome, and didn't you miss it, right? So, but normally attorneys historically, though it's shifting a little, get paid by the hour, and so they record, you know, you mean we talked about their kid for part of that phone call and they billed, anyway. If you do fixed fee, you get away from that. And so I think a lot of estate planning attorneys are doing that, but you want to know what's included in the fixed fee. Are they going to fund your trust or make transfers to the trust or not? How are they going to guide you through that? Can you pay additional to do that? You know, just know what you're purchasing, and it's okay to ask. Yeah.
So if you're under the $5.4 million,
yes.
What would be a range of estate planning fees? And I say range because there are a lot of. Is this $2,000, $3,000, 1% of the?
It's not a percentage. I will tell you that. And it depends on the attorney and how they work. And honestly, it doesn't have to do with the size of your estate. It has to do with the complexity of.
But if it's fairly straightforward, maybe a farm, assets and stocks and bonds, a house.
Right.
Fairly simple.
I would say, well, I mean, I actually have my fixed fee schedule here, and so I could show you what mine are. I'm told mine are kind of middle of the road. But for a single person, it'd be somewhere in the I should know this by heart, but like $2,200. You do the pour over will, you do the funding, you do powers of attorney for property and healthcare, health directives for a single person, and then, hang on, wrong thing. So yeah, we say for a single individual, $2,200 to $3,000. For a married couple, if we're doing 2 separate revocable trusts, we do $3,600 to $4,400. And then if we're doing a joint revocable trust, which we're doing more of in certain cases, if we have a couple who's been married 40 years, they have $1.5 million. They're 3 kids from that marriage. We sometimes do 1 joint revocable trust, and that's $3,000 to $3,800. And in Oklahoma and kind of in this market, I think that's middle of the road. But again, I just stress to you that make sure that the fixed fee they're charging, that you know what it includes. Not just drafting the documents, but also doing deeds to transfer the assets in the farm, and that they're going to record that. And you know, if you have an LLC, they're going to assign it, or at least tell you what to say to your investment advisor, or coordinate with them on getting it in the trust.
So $5,000 to $10,000 would be a pretty good estimate, wouldn't, if it's not too complex.
I think that's too much,
yeah.
Honestly. I think if somebody wants to charge you $5,000 to do your estate plan and do it right, they're charging you too much. But it should be under that.
What's the benefit of a married couple and having each a separate trust as opposed to joint trust?
Okay. If I have a couple who I think could possibly need both exemptions, even though we have portability, I think we don't have portability of the GST exemption though. So you use it or lose it. If I have a couple whose estate is a little larger, I'm going to do 2 separate trusts because I think, and this is a stylistic thing, because I know people who do joint trusts and do that planning in one trust, and I just think it works better separately. I typically do 2 separate revocable trusts, one for the husband, one for the wife, and when the first one passes, assets up to the exemption amount, GST and estate tax exemption, are then made frozen and in another trust. And it's just easier to do than trying to pull it out of a joint one.
Later,
The other times we do it is when I have a client, one of whom is worried about liability. Maybe they're a neurosurgeon, and the other one is a housewife or a house husband. That's happening a lot more now. And so we will actually put assets that are exempt from creditors' claims into the physician's revocable trust, and the ones that have potential exposure over in the non-exposed spouse. Sometimes people are going to inherit from their family, and they want to keep that separate from their spouse so that they can make sure that goes on the way that they want. So there's different reasons like that. So sometimes it's size of the estate, sometimes it's blended families, sometimes it's inheritance, sometimes it's liability.
So would that be kind of similar with like an S corporation, that you would probably want the S corp to be separate, so you'd have 2 instead of 1 joint marriage?
You can own it. You can say that it's owned separately, even if it's in a joint trust. But an S corporation, okay.
Sorry.
No, for liability, there's some. When you form a corporation or an LLC for a business, the reason typically you're forming it is to protect your assets from liability. So if the business gets sued, they sue the business, and they can't get beyond that shell of the business to your personal assets. The other reason we sometimes form those kinds of entities is because for valuing them for estate tax purposes, an interest in the Robertson real estate company is worth less than the 3 properties that it owns, because someone's not going to buy an interest in a privately held company, but they might buy the properties. So there's some discounting valuation issues in sometimes owning things that way. So the question was, do you split it? Here's the thing, if you, for an LLC, if you own, one person owns it, it's called a disregarded entity for income tax purposes, and you don't have to file a separate income tax return. So sometimes when we're forming those companies, we want to do it that way because it doesn't complicate their income tax filing. Other times, if we're worried about discounts or valuation discounts and we don't want anyone owning a majority, we might want to split it up. Or if we're, so there's just, that's probably like a whole hour kind of discussion depending on the business in it. Did that sort of answer your question? Not really?
It's okay.
Okay.
Talk to me about it.
Okay. Yeah.
Okay, we've got different age groups in here. My question is, when should you, if you're going to entertain doing a trust, and I pay you whatever your fee is,
Right.
how many times in my lifetime am I going to have to change it
Right.
because of the sale of property and this, that, and the other, and how difficult is that?
That is a great question.
Having been in the finance side, when I'd get a title of a car that was in the trust of so-and-so and so-and-so, we had a problem, we couldn't lend on that without it going through another process, so I'd
Okay.
like to speak to that.
Okay. So I see there's about 4 questions in there, kind of. One of them is when or why do I need to do a revocable trust? And I'm hoping that maybe some of you guys can answer that in, it has nothing to do with the amount of assets you have, it has to do with whether you want to avoid probate or not. I mean, that's the answer to that question. We have done revocable trusts for people with $75,000 estates because it was the easiest way to avoid probate, and then when they passed, it just distributed outright and was very simple. You can do very sophisticated planning within a revocable trust, and you can do very simple planning. So a lot of times people say, oh, I don't have enough money to have a trust. And I'm like, it's almost like the smaller the estate, the more I would say you might want to have a trust and avoid probate and not spend a bigger chunk of the fees on probate fees. So it doesn't have to do with money or really age. Once you create a trust, generally it'll be like your name, revocable trust, dated June 13th, 2015. And then I have one client with a 6th amended and restated trust. Okay, he's had it for 30 years. He's changed it 6 times. Most people maybe once or twice, but you can change it as often as you want. Most people draft it in such a way that you don't need to change it for changes in the exemption amounts. It's done based on whatever that amount is when I pass. So you don't have to change it for that. Generally, people change their trust because they change who they want the trustee to be. They want to add a beneficiary or change who's receiving something. Most people draft it so that it goes equally to all my children. So some of our younger couples, they have additional children. You don't have to come change it. Then the assets. Okay, you don't list the assets in the trust. You just create a trust that says here's what happens to anything owned by it. So as you acquire new assets, you don't have to amend your trust or call the attorney and change it. You just take title in the name of the trust. Cars and bank account, or sometimes the loans on the house, what we would find is we'd put the house in the trust and then they'd refinance and they'd say, well, we can't do it in the trust, and they take it out. They don't do that anymore generally. I think mortgage companies are more and more comfortable with the fact that it's really them. We don't have to do that. And I think probably with car titles the same.
It's a little better now.
Yeah, I think I've really noticed a lot of improvement in the volume of calls I get where people being frustrated when they go over to the tag agency to change the car, or when they purchase a new car and say, I want to put it in my trust name. Or the credit unions are, yeah. And we get asked that a lot. Well, what if I buy a new car? What if I open a new account? Do I have to come and amend my trust? No, you just take title properly. And honestly, we don't. Some attorneys will do like an annual fee to evaluate or review it, and I've had people say you should do that. The vast majority of my clients, I think that's a waste of their money, and so I just try to tell them, anybody passes away, you want to change trustees, you want to change beneficiaries, you call me. You have a major change in your assets, call me. If there's a change that affects the law, I'm going to be calling all of you. So, but then some people with more complicated estates will meet maybe once every couple years. I have some that I meet once a year. I met with somebody and it had been 10 years and everything still worked right the way that we wanted, but they wanted to change a trustee. So, did that answer most of them?
I've seen a lot of silly things in trusts, like, my 2014 Prius with 15,000 miles on it or something like that.
Yeah.
Goes to my granddaughter who will use it when she's 16. I mean, it gets kind of ridiculous. And
that's bad drafting.
Yes, absolutely. And when I was working in a financial institution, we'd get some of those, and it did become very cumbersome.
Right.
Trying to make sure we honor our account agreements versus also honor the trust agreements. And there were a lot of times that the individuals got very upset because of those issues conflicting.
I think, and I mean Debbie can speak to this too, but I really encourage clients to think not about the specific assets, but percentages or values and things, and then that way as those assets change and evolve over time, which they will, you don't have to amend it or change it and it still works. With personal property, something that can be done is that you can make a list of things like the car or the jewelry or I have somebody with a koozie collection. What else? Guns. In Oklahoma, the guns, are a big thing. So we do kind of a little memo, and they can do it in their, we give them a form, but it doesn't matter. As long as you sign it, date it, refer to your trust and say, hey, here's my personal property wishes. And then in the trust we say, if I leave a separate writing, honor those personal property items first. Now that can't be money, it can't be accounts, but it can be, non-titled. Well, actually in the case of a car that would probably work, but you know, personal property stuff. And then that kind of stuff I think should go separate from the actual trust agreement and be listed separately so you don't have to amend your trust.
Some of these were very old trusts. So,
Yeah. And you want to, that's the other thing we found is that you really want, sometimes my clients are like, really? You're asking me what if all 3 of my children are gone and we're gone and if there's, why are you, that's not going to happen. Well, it could, and it does sometimes. So you've got to really follow things down because sometimes, you know, these trusts, I mean, you saw trusts from 40 years ago and we still see them too. And so you want to make sure they still work. So sometimes people want to get real specific on, he can't get a distribution, or I want this amount of money and it can only be for these reasons, and if he's not working, you know, I mean, and so you've got to be really careful because there are so many things we can't anticipate that could happen, and you're stuck with this document. So yeah, that's a good point. The one thing I haven't talked about that I really need to, and then I'll let you ask a couple more questions before we break. Durable power, part of estate planning is not just all the stuff we've talked about, what happens to my stuff when I die, and, you know, gifting, but also probably half of us are going to be incapacitated at some point in our life, right? For some period, you know, 90 days. I think I saw a statistic that said 50% of Americans will be incapacitated for 90 days or more. At something like that. So a lot of us are affected by incapacity. I don't like to go to court. I don't want to go to court. I don't want to talk to other lawyers other than the nice lawyers with whom I work. So, no offense. So one of the other important documents that we always draft when we do estate plans are durable power of attorney and health directives. So these are, I mean, estate planning lawyers are going to have a form. These are not expensive to draft. I tell people there's complicated stuff I do. A durable power of attorney ain't one of them. I really am plugging your name into a form pretty much. You know, sometimes we do some other stuff. But you want to say, if I can't pay my bills, if I can't talk to the utility company, so property type asset things, who's going to take care of that for me? For assets in the trust, your successor trustee will serve that role. So it's trust will generally do an incapacity role as well as administration of the assets upon death. But we still need a durable power of attorney for property because you're still going to own your IRA individually. You're still going to own your insurance individually. What if you find that property that didn't get transferred and the person's alive but incapacitated? The power of attorney could get it transferred and avoid probate. So generally, the person named there is going to be the same as your successor trustee in your trust. And then you always want an alternate, at least one. I've seen some powers of attorney for property where husband and wife name each other and there's no alternate. And I'm like, what if they're in a car wreck and one of them dies or they're both incapacitated? So have a power of attorney for property that is a complement to your trust. Then we do a separate power of attorney for health care. Some people will do one durable power of attorney and put both in there. But what we found was often you want somebody different to make health decisions for you than you want, you know, managing your assets, especially if you're married and it comes to the alternate. So you may want your spouse in that first alternate role, but if my spouse can't make health decisions for me, you know, that could be very different from somebody who's managing the assets. So I use my family as examples. So my dad is super squeamish, but he was an investment advisor at Merrill Lynch. Okay, he is not going to come anywhere near my health decisions ever, right? He wouldn't even look at my ultrasound picture. So he was like, no, and I thought, all right. So my mom is the backup there, right? But my dad is really great with finances and assets and so forth. So I encourage people to think about those are two very distinct roles. Don't just think, well, here's my person and my alternate and my other alternate on everything. They're very different. The other thing in Oklahoma, we have an advanced directive for healthcare. It's often referred to as a living will. Texas's is a directive to physicians and surrogates. That's their form. Most states will have a unique form for indicating your wishes regarding life-sustaining treatment if you are terminal or you're in some other irreversible condition and you can't make health decisions. So we got in Oklahoma, you need to use the Oklahoma form. We have a lot of clients, and I refer to Texas because we have a lot of clients who have homes in Texas. We have a lot of people moving back and forth. It turns out they don't have a state income tax down there, and so some people retire down there. And so for some of our clients, we'll prepare both of those forms if they're going to spend significant time in both places. It's valid either way, but again, you don't want to be arguing with a nurse about they're looking at Oklahoma's form and you're at Corpus Christi and they don't know what it is. That's something you can do on your own. If you want to see Oklahoma's advanced directive form, they'll ask you at the hospital, they ask you every time you go to the doctor. But okbar.org, and that's the Oklahoma Bar Association, and there's a public link. And if you click on that, there's some good information, but one of them is a link to the advanced directive form. And you cannot change the form, you can only sign it and fill in healthcare proxies. And those are people who don't make your health end-of-life decisions the way the form's designed, but they're there to talk to the doctors and nurses about whether you meet the definition. So what we've found though is, I mean, you plug their name in it and their birth date and their address, but we spend more time discussing the living will and advanced directive with clients when we're signing than anything else. So I think they've tried to make a form that anyone can just go get at the medical association or the bar association or at the hospital, but it's really confusing. So we think part of what we do, we should explain that. And I've been to legal education classes on that stupid form and how it works. So, okay, that's my time. If you guys have any other questions, yes.
Difference between durable power of attorney and financial power of attorney. I'm financial power of attorney for my brother.
There's really probably not a difference. I'm guessing your financial power of attorney is durable. Durable means it survives incapacity. So if your financial power of attorney for him, it probably has a provision in it that says it continues to be effective upon his incapacity.
It does have that in
Okay. So it's the same thing, it's just, again, some of those different terminology that make it confusing. So the power of attorney, like if I'm going overseas and I'm closing on a house and I want someone to sign on my behalf, I can give a limited power of attorney that just says you can sign that. And it's not necessarily durable. It only lasts as long as I have capacity, and then it durable power of attorney is what avoids incapacity proceedings and getting a guardian appointed. So I bet that's what it is. Yeah, and then one thing I heard a lady say is, oh, no, everything's fine with mom because I can take care of all her stuff when she's gone because I'm durable power of attorney. Okay, durable means it survives incapacity, it doesn't survive death. So once someone passes, those powers of attorney are worthless. Well, but I went to the bank and they let me, did they know that she was dead? Well, no. Okay. I didn't, la la la. So,
I didn't hear that.
yeah. So, no, that's a good question. Okay.
So would you have to then be the executor accept the will to be able to survive the death? If you were at the durable power of attorney, would you then need to be like the trustee or whatever?
Right. Yeah, upon death, you want to be, if you're going to do probate, everything sort of freezes, and until that personal representative, also called an executor or executress, is appointed, nothing can happen with their stuff. But if you're successor trustee of the trust, you then can step in immediately into that spot. Yeah. Yeah. Okay, well, I'm going to be here all morning. If you think of other questions that you didn't want to ask out loud, I'll be here.
Thank you, Christin.